update. Today we're doing it a little bit earlier. It is a Fed meeting day, so we are going to have instantaneous feedback on our presentations as the Fed does meet today at 2 o'clock. So with that, I'm Charlie McQueen, President of McQueen Financial. Co-presenter today is Craig Cecilia, our Chief Investment Officer, who's overseeing all of our investment portfolios here at McQueen Financial, which is a topic we'll talk a bit about with cash. Administrative-wise, if you have any questions, please feel free to ask them, like some of you just did about the unable to hear us in the Q&A box. And at the end, the webinar will be available. If anyone would like a copy of it, we'll happily to share it with you. Just give your advisor a call and they'll get it to you. So today's topic, we're going to talk about an economic update. We're going to look at the stock market, the consumer, housing, general economic activity, interest rates. We're going to talk a little bit about margin and non-interest income, and then we're going to go through some predictions. So really excited to go through all of our topics today. So one of the things that we've been spending a bit more time on over the past couple of years is the stock market, and definitely an interesting run in the stock market. And here we have a graph of the stock market showing how things have come along the way. Craig, any comments you want to add on the stock market?
It's been really interesting to watch what's happening in the stock market, as there seems to be a little bit of a digression between, say, big tech companies and the rest of the market. We definitely seem to have some overvaluation. I think today with Snowflake's IPO, that's already 135% of their price. JFrog also up, I don't know if it's 100%, but I think it's up around 50-some% as well. But we're seeing some digression in different sectors and whatnot, and it's just kind of very representative of what we're feeling is not only for people going after certain areas and wanting returns, but the amount of liquidity is helping drive some of this stock level pricing that's taking place, not only on these IPOs that I mentioned, but on the indices as a whole.
Yeah, it's interesting. The stock market has done quite well, but one of the areas that's been a little bit slower and struggled to rebound after this last drop was the KBW Bank Stock Index. And I think there's a bit of viewpoint that the industry is definitely, there's concern about the banking industry and potential credit losses. Are you seeing the same thing from your analysis, Craig?
We are, and there's several factors that's playing into this. One is the low rate environment for cost of funds, and will they change? We'll talk a little bit later about deferments on loans that are taking place, the ultra low delinquency rates that everybody is experiencing, and all in all, the uncertainty of COVID on the effect on asset quality is really causing an undervaluation in that sector.
Yeah, it's definitely an interesting spot and a lot of concern and uncertainty, although we are seeing some thawing with the number of deals being announced, transaction volumes we're showing some thawing and things improving. So definitely, though, it's been lagging. So I think a couple of things I look at the stock market, significant rebound here, and I attribute a lot of just the amount of cash. There's cash everywhere chasing assets, such as Snowflake today is a great example. Priced, I believe, $80 a share a week ago and came out at $240 or $250 when it actually opened up.
Yeah, trading right around there, even up to $270. So just amazing what's taking place out there.
Yeah. One of the things to help with earnings, you've been managing a number of alternative portfolios for our clients, and it's exciting. We're looking at things that are an alternative for credit unions to utilize instead of just a standard bond portfolio. And while these don't look like returns of the NASDAQ, we have to remember these are hybrid portfolios of income-producing activities. And so it's a pretty interesting spot here. And you've got some great returns so far, 6.99, 6.25, 5.44, some really, really nice numbers.
Gotcha. I appreciate you mentioning that, Charlie. We got to keep in mind that some of these portfolios that we've been managing in excess of 10 years are a good mix of assets, as you had mentioned. Some don't have any equity exposure at all, just kind of using some hybrid type of securities or different fixed income securities that are close to being a traditional portfolio, but just outside those parameters. So it really is, everyone's customized differently to what each client is comfortable with from a risk return analysis. And
yep. That's great. It's a great way to add additional earnings for our credit union friends. Well, looking at the economy, one of the best ways to understand what's happening in this economy is probably not to watch TV, I've learned. Leaving the TV off, or at least watching a half hour of Fox News and a half hour of CNN, and then you don't really know what's happening because they're the opposites, and then you pick somewhere in the middle. But really the best way to know what's going on is to watch the consumer, because the consumer is 70% of the economy. And in my Charlie anecdotal mathematic version here is traffic stinks. There's a lot of traffic when I've been coming into the office here, and I'm kind of getting tired of it. I like the pandemic days when there was no one on the road, but we are seeing some activity. But, you know, we look at consumer confidence. Craig, maybe you can give us some insight, your viewpoint here on consumer confidence.
I sure will. I love the analogy about the traffic, by the way. You can't drive as fast, can you?
No, you can't.
So consumer confidence is just amazing looking at this chart. You see there's two lines I really just wanted to focus in on. I won't spend a lot of time, so we've got a lot of stuff to get through. But the green line, the top line, that's current conditions. That's us as consumers. How do we feel about things that's taking place right now? And if you go back the last 5 years, people have been feeling very good about things relative to what they feel is going to happen in the future. The 6-month expectation line, which is that red line. So you can look back to 15 all the way to the beginning of 2020. We're feeling good about now, but a little uncertain about what's going to take place in 6 months now. And now you can see with this COVID era that we're in right now, how current conditions have just dropped off the end of the table there, and where they're feeling that, you know, as a 4-point there, it's going to look better down the road in the future. You know, the eternal hope, you know. Right. Spring optimism springs hope, or whatever that saying is. So it is neat, and I think it's really representative to say, you know, there is a lot of uncertainty on how long things are going to be here and how long it's going to be affecting our economy and us as bankers, our balance sheets and income statements. So. Yeah, just a little comment there on how things have equalized. And
you did say you'd be quick on that one, which you weren't, so I appreciate that. U.S. household debt is really an interesting thing, income to debt here and debt to income. The thing to look at here is the hockey stick on the far right corner. And what you can see here on the green line, which is income, income has shot up substantially. And this is a combination of enhanced unemployment benefits. Unemployment was paying an amazing amount with the weekly bonus. On top of that, the direct deposit of money from the federal government, and add to that even the PPP loans. A ton of money has gotten into the hands of the consumer, and actually not much additional debt either, and we'll talk a little bit about that. But the consumer's looking really good in a debt standpoint. And I think one of the ways to highlight this is where the consumer stands with one of our pretty graphs here. But if you look at here where they stand with credit card debt has been flat to down. Overall, consumers, we're seeing consumers pay down debt. Auto loans is kind of marching along, down a little bit, but still marching along. And still the big one in the room is the student loans, which again, we'll talk in a minute. You don't have to pay those anymore, I don't think. Well, maybe I was foreshadowing. You have to pay them a little bit, but delinquency isn't nearly as bad. You know, is my comment there related to student loans that if you don't pay them right now, it's okay. And so there's been a lot of lack of delinquency now because they're not. Otherwise, though, if we look at things here, home equity, very, very level of delinquencies. And then if we look at credit cards, even trending down lower. And Craig, you had some great comments on auto loans and comparing back to 2009 and 10 and to today.
Yeah, it's interesting to think about when we were in the Great Recession. I think that's what they still call it at this moment. It hasn't been
financial recession.
Financial recession, and how they really were one of our peak delinquency years or eras for auto lending. And if you see how they've recovered over from 5 years forward to where we're at today, we're basically back to delinquency levels during the financial crisis. And I know there's a lot of participants on the phone today that they do a lot of auto lending, and so we just want to make sure you notice that, acknowledge it, and look at the trends, and make sure that it really doesn't change our credit behavior on underwriting and whatnot. And it's also interesting if we'll look in a little bit about auto production and sales or whatnot, and how it's down. So it's very surprising that it's up this high right now for me, quite frankly.
Yeah, it is interesting. It's a little different, and maybe there's some preemptive people trying to not make payments. But here again, remember, when people compare this activity to the financial crisis, we were around 7% on credit card delinquencies, and today we're at 2.5, 2.4. So still just amazingly low delinquencies at this point. One of the reasons why things are going so well is unemployment and hiring. There were some shock numbers we're going to talk about in the next page here. But what we can tell you is that there's very, very few involuntary job separations now. It actually dropped below the average for the past couple of years this last month, and is still there. So people are not involuntarily being fired anymore. Believe it or not, I see a lot of help wanted signs when I drive places, and it's hard to find good employees. I have clients telling us that over and over again. Job openings, not a huge number still. So this really shows some good data after an ugly blip up.
Just one comment, Charlie. You're probably seeing those help wanted signs because of traffic slowing you down a little. You can pay attention a little more.
It's a fair point. Actually, you can see something besides a blur. So continuing, no, that was good. Continuing with the unemployment here. We have the state of Michigan here to make fun of our state because of our crazy governor, one would say. But we have an interesting situation where the United States, we were cooking along around 4.5% unemployment, just below that 5% number. And we kicked all the way up to about 15% in the United States. So simple math, we went from 5 to 15, doubled. And then we've come back down now to 8.4. So it's coming down very, very quickly. And even Michigan, which we all have our 2 cents, those of us that live here, about our governor and her decisioning. But we went from roughly the same number as the United States, around 4.5%, all the way up to about 24%. And so we saw this massive spike up, and we're now all the way back down to 8%. So we are seeing a lot of recovery in the employment area, which hopefully that continues and we continue to see improvement.
Yeah, and just one little comment there is the economy is the employment number is improving a lot, but we got to make sure we pause and give thanks to the federal government, because the last report of about 1.3 million, 1.4 million jobs, a quarter of them were federal jobs, and a lot of them tied to, say, census workers as well. So I always just mention that, one, to be humorous, but two, we got to take it with a grain of salt as well.
Well, I'll tell you one thing that's interesting as you look at this is it's not always the same jobs that are available that people have lost. As we see retail continue to fall, Yelp announced today that they believe that 60% of all temporary restaurant closings are permanent. And so there's a lot of people from that industry going over to things such as Amazon warehouses. As Amazon announced they were going to build a ridiculous amount of warehouses basically in suburban neighborhoods. So when you order toilet paper, it shows up on time. So really interesting how this whole model is changing quite a bit for everyone. So as we think about the consumer, it is really interesting. The consumer is 70% of the economy. Everyone keeps saying, when is it going to fall apart? When is everyone going to go delinquent on their loans? Well, the hard part about going delinquent on loans is when you have cash everywhere, it's hard, and we're seeing, as our clients tell us, everyone has lots of cash. We're also seeing that debt payments are at low levels. We're at record low interest rates. If you're able to refinance a mortgage or a car loan or anything, the cost of debt is so extremely low today. And I think that's a significant modification. Unemployment has filled in well. If you were receiving unemployment payments, it helped you get through, especially with the bonus payments. A lot of people, from my understanding, were getting pay raises in unemployment. And it's also tough to get people off unemployment when you're not required to actually look for a job. Still, a lot of changes, a lot of very sad stories. But we're seeing that there were some good government programs that filled in. And I think this, and Craig, we were talking about this earlier, CECL is coming right around the corner. And we were spending a lot of time talking about CECL. Our last webinar was on our CECL product. It's basically one of the scary things and why it's, I think, important to start CECL sooner than later. The best indicator that ties to loan losses is unemployment. And so, if you're using a static 1-month unemployment number, your CECL number is going to be bad. But looking at a rolling unemployment number, I think you were talking about a 2 to 3 year rolling number you like?
Yeah, well said. If you could correlate your CECL calculation to one, market condition of unemployment, and you only look back for the last, few months, you're going to be having a heck of a day trying to keep up with your reserves, right?
Yeah.
So, when you have economic cycles that are very erratic, you got to be really careful not to look so short term, but not only look 1 year, but look back 2, 5 years and look at the trends and look at that relationship. It gives you better numbers. And, GDP is going to be a great example. As you go from a negative to a positive, it's the percentage change from quarter to quarter is going to be huge. So looking back a little farther is really important.
And you said erratic and didn't bring up my driving, so that seems to be an improvement in our conversation today. So speaking of that, we do have a new loan loss analysis, and this is something that, working with some of the transaction advisory we do and with ALM work that we do, it became an interesting conversation. People want to know, is my loan portfolio going to perform well? And that's a tough question, and it's a really tough question to a loan expert and to a mathematical person. And so what we did to help look at this is nothing is equal and everything is erratic, as Craig said. And so by looking at NAICS codes, we've been able to make a determination of what industries we believe are going to do well and do poor. And so that's been actually a really good thing. And we're using data from over 300 institutions across the country right now to validate our process. And we'll talk a little bit more about this in the recovery conversation we're going to have here in a couple pages. But really an interesting thing to think about as you go forward. So, I think one of the things that's been the absolute high point of the economy is the housing market. And this is one of the things that makes the consumer feel good. If we think about this, we talked about the consumer and we looked at some data points on unemployment, but we also talked about the stock market. The stock market's doing really well. So me as a consumer, I feel good when I get up every day. My stock portfolio has done well, or my retirement account has done well. I have a job, and now my house is worth more. And so today, this is really an interesting thing. When we look at the home price index, we're seeing that the nation continues to do quite well. And I think a bunch of this is, if I can't get on or don't want to get on an airplane, or I'm scared to go places, that I want to be at home. And we're definitely seeing people fix up homes, buy new homes, really causing some interesting activities today. New existing home sales, another good spot here. When I first saw this chart, I thought, what in the world is going on? Existing or used homes, sales are down 4.7 million, which I expected them to be about higher. But the reason why they're down as much as they are really comes down to the fact that there's a supply and demand issue. There's not enough homes out there, which is why we'll see that the opposite of that line there is the new home sales now coming up based off the left-hand side to almost 800,000. Still well below where we were back in the early 2000s and late 90s. So we've been in a drought of new homes being built for quite some time. So with that, we have another interesting issue, prepayment speeds on mortgages. As we tie a lot of our mortgage activity and housing back to our institution, Craig, what have we seen in prepayment speeds today?
So we're definitely seeing faster prepayment speeds as you look at this chart. The 1 month is more of a current number, and then the 3 month is an average 3 month of the prior trailing 3 months. And it's really interesting because as we look to book assets on our balance sheet, through our lending portfolio, through our investment portfolio with CMOs and pass-throughs, some of this speed correlation to coupon or WAC on these loans is making sense, and there's others that do not make sense. You can have a low mortgage rate and with a 2 handle on it and still having a high prepayment speed on it. So it's really tale-telling that you have to really be careful when booking these assets. And a lot of people in this low-rate environment, where we're going to look at the curves in a little bit, are reaching for some yield. And we got to just make sure we sit back and caution and make sure you guys, through your ALM model, do some simulations of really what's this going to affect me if I'm wrong and these speeds really do, say, slow down and have an extension of assets.
Yeah, it's an interesting viewpoint. I mean, once I get my home perfect, why would I ever move, right?
Certainly.
But it's fast prepayments because everyone can be refinanced today. And here we are in Detroit, the mortgage capital of the country. Who would have thought? Autos and mortgages, Quicken Loans and United Wholesale Mortgage, massive IPOs there also. But the housing market here is supply and demand. There's not enough supply, and one of the big things is not enough new homes being built. It's a very regional issue too. Some regions have more builders, some regions have less. But millennials are also really entering prime home buying age. And a lot of people I talk to about wanting to get out of apartments or out of high-rise buildings, a lot of unique things that we haven't experienced before. So I think this is going to continue to push supply and demand on housing really for quite some time, and low interest rates don't hurt. Another component, MSR values, as Craig talked a bit about there with where we stood with prepayment speeds. Values are definitely lower in the mortgage servicing rights valuations given the overall high level of refinancing, but we are seeing OMSR values, and that's the originated mortgage servicing right when you record, those really need to be reviewed. So if you haven't reviewed your OMSR values and where you're booking them, and please feel free to reach out to one of our team members. It's just something that's definitely a unique spot today. All right, so we've talked about the consumer, and really that's 70% of the economy. Now let's look at some general economic activities and think through the generic economic position. And Craig, this is one of the most interesting charts of the day, I think. Help us a little bit with this.
You want me to put common sense to this chart here? Is that what you're asking me to do?
Yes.
So, as we look at this chart, I want to focus in on the red line. This is the reality line of what's taking place, what we see on a quarterly basis of earnings or 10Qs and call reports and corporate profits year-over-year change. And you can see since we left the recession, we had the spike in change in year-over-year for obvious reason. That spike, it looks wild, but it's because we went such a big negative to a positive, and we talked about that looking back too short of a period of time. But since then, it's trended down on average, and even currently, you can see those corporate profits being a little lower than we would really ideally want to be. And then look at the S&P index. You know, we're at all-time highs on stock markets, yet corporate profits continue to trend down. So that correlation is not making a lot of sense there. But it really is one of the reasons that we're seeing that, in our opinion, is the amount of liquidity in the marketplace, not only on individuals' balance sheets, but on corporations' balance sheets as well. There's a lot of wealth out there, and things are getting a little bit higher value than historically would from a price-to-earnings standpoint.
So does that mean the stock market's overvalued in your mind?
I didn't say it's overvalued, because there's always value in the market. You just have to be smart about what you're picking and ride, not just because the whole market's going in that direction. Yeah,
it's definitely interesting that this chart does show some interesting disparities, is a term I'll use. Well, and then the stock market didn't perform nearly as it would have expected in 2008, 9, and 10 from that, or 11. In 8 it did, but not 9, 10, and 11.
Right.
Well, one of the markets that I think is acting actually correctly and understandably is the crude oil futures. And I love this chart because there's such disparity. The far left, we were in the $100 range, and that's not normal. We shouldn't have been in the $100 range. That was a political position of our country of making oil expensive to get off of fossil fuels. In the end, what actually ended up happening is we became really good at mining and getting our own, and U.S. is now the world's largest producer of oil. We're oil independent, which is just amazing to think that. We're actually exporting natural gas, just an interesting spot we're in. So they look at this, we should be probably closer to $40 a barrel, $45 a barrel, maybe 50. We had this cliff we fell off back in 2000, or March, April there of this year. Basically, there was nowhere to put the oil. Every swimming pool was full. And Texas is our line here. But the good news is we're running around $40, $45 a barrel. It means there's enough demand that the economy is going well. If this drops off, it's a great indicator the economy is slowing. If it skyrockets up, that means we're fired up really fast.
Yeah. Another thing to think about, if you look back in history, is we had a big push to go towards alternative energies. And at first, it was the natural gas, and you mentioned the exportation of LNG, liquid natural gas that we're doing. It's easy to transport. The price of that's just terrible, so don't invest in that right now, just as a little advice. But looking for oil, though, our expectations going forward, is it the Tesla effect? There's a lot of companies that are getting on board with this, and it's really actually taking effect where it's a popular mode of energy for people, and they're building out the infrastructure for charging stations as well. So I think the demand's always going to be there from a manufacturing standpoint, but not quite as much from a user standpoint in the retail space.
you're spot on as usual, but I'll just say, what are we using to generate the electricity to run through the inefficient power lines to charge your Tesla?
Big gerbils.
Okay, perfect. So speaking of Teslas, auto sales, we fell off the cliff when it was illegal to sell a car in a lot of states, namely here Michigan. We've recovered back. We're not all the way back yet, but what we're seeing is a bit of a supply and problem. And as we were talking before this webinar, between Craig and I, we've gone to a couple different car dealers this last week, and parking lots are fairly empty. And so that's something we're seeing is a lack of inventory. But things have come back really well with auto sales. We're actually seeing used cars trading at incredible values right now. So definitely a spot where I think we could see some positives. But I don't believe those high-cost cars are going to lead to inflation. Craig, are you of any concern about inflation? I know the Fed's got a lot of comments on inflation lately. Maybe you can enlighten us a little bit.
Sure. It's been a hot topic lately with inflation, and it's in the last 10 years, it's the second time they're really saying, let's pause for a moment and realize that if we have a fixed target on inflation, it might not be the best thing for our economy. And I'm boiling it down to really simple terms. And I'm not that worried about inflation right now, even though we do have this massive amount of liquidity on not only corporates but individuals' balance sheets. You kind of look at the numbers and the inflationary numbers, and they're not growing. I think a little bit, let's go back a moment and think about that auto industry and the lack of supply. And you look at the supply chain. There still is some supply issues in a lot of different industries. And the reshaping of our economy, you made a joke about Michigan becoming a mortgage market, right? Yeah. Michigan needed to reshape. They've done it somewhat thanks to a few entrepreneurs. But the world is as well with the Amazon and delivery methods. So I don't think that inflation is a big concern. I think what's biggest concern is to slowly wean ourselves off of the federal government spending. And when that happens, we'll see inflation not continue to rise, and we'll still be around that 2 or less % rate.
All you said was weed ourselves off, and I'm thinking of cannabis banking now, but that's a whole other issue.
Reshaping the economy.
Reshaping the economy. But inflation's not a concern, and I agree with you, Craig, what you said. I look at this as what we learned is no one likes deflation. And if we didn't learn that back in 2009, 10, we're not good at learning lessons, I guess. And so as we go forward, the Fed would like more inflation than deflation. Fair statement?
Fair.
Okay. This is a tough number. This made a lot of headlines. GDP, the number that's announced is an annualized number. So you take the quarter and you annualize it. Now, the second quarter GDP was roughly minus 8%. 8 times 4, about 32%. So here we are at negative 32. A shock and awe number. The world did shut down there pretty fast. I do expect this is going to come back quite dramatically. My estimation is we're going to have about a positive 20% improvement in GDP this next quarter, quarter 3 that we're almost done with here in another couple of weeks. And it'll still end up being a negative net number at that point as we take 20, it would be 5% first, but 20 annualized. And you take 20 and 31, you're still negative, probably 12, 14, 15%. But we think it's going to head in the right direction here. This is a number that a lot of people reacted to at first, but I think it's softened up a little bit. So you've got to have fun, and this is the alphabet soup day here, and we hear about the V recovery, this Nike swoosh recovery, the hockey stick recovery. This is what we call the K recovery, and a lot of people talk about this as being, higher income, lower income, and I don't look at that at all as a higher income, lower income. I look at this as a much simpler way. The economy is going along really well if you're in the everyone else bucket. If you're in the bottom half of the K, the economy is not going very well for you, and that is if you're in the travel industry, transportation, restaurant, resort, convention, hotel. That industry, those industries are obviously struggling very, very deeply with a lack of travel, a lack of conventions, no in-person meetings happening, obviously Zoom and Google and all the other platforms that are doing quite well. But this is where we think that this is going to be a different recovery. And so for every institution, all of our clients, this is going to impact them very differently. There was an article about one of our clients in the newspaper yesterday who talked about how they have a lot of their customers are restaurant and hotel and resort type groupings and people that work in that industry, and they're having some problems. So I think as you think about your planning, your interest rate risk situation, your ALM situation, you've really got to work to plan this carefully, because how this is going to impact each institution is very different than others. So I think this is, again, it's not fair, but this is the recovery that we're running into. It's very different for everyone involved. Okay. So from there, talking about interest rates and doing a little bit of an interest rate conversation and predictions here. So Craig, this is one of our favorite charts. This looks pretty flat to me though, the red line. Sure.
Today's yield curve looks flat relative to, call it 8 years ago. Relative to a year ago, it's steep as you would want it, That's steeper than a bunny hill at a ski resort. So we're getting back to a little bit of a normalcy of a curve. And you mentioned earlier about GDP, some recovery, some positive things happening in the economy. And we don't expect the curve to change all that much in the foreseeable future, but we do expect it to remain positively sloped here. And we think that this is going to be just a sign that the 10-year being around 68 basis points, we might have some leak going up a little bit, and that's a positive thing for all of us, because it's saying that the economy is slowly improving and getting a little bit better. You just got to be careful, man, not to be extending your durations too far out in this rate environment right now.
So did I hear you say that the bunny hill here, a 54 basis point 2 to 10 year spread going from 0.14 to 0.68 is a nice positive slope yield curve? Did I hear that right?
Absolutely. The average spread between the two for the last 2 decades has been around that. If you go back into the, say, 80s or something, you're talking a couple hundred basis points. But yeah, this is a nice positive slope, and as everybody loved to coin that new phrase, the new normal, if you will. This is where it's at right now, and it's a function of inflation and being at low rates.
So what were the spreads like in the 70s?
Well, they were high. Late 70s, you got into where you're into at the tail end into the high double-digit interest rates.
Yeah,
so your spread there is about 500 basis points.
So now that we have marijuana coming back into the market in free levels, is that going to go back to spreads like that?
I'm not so certain, but it just depends on how much tax revenue we'll be able to collect off that whole industry.
Al, that's an interesting viewpoint on tax revenue there. It might be positive for all these cities that are struggling. This is a neat chart as we go back to, we've got the two lines on top there. We've got Brazil and China, so we have the Banana Republic and the communist nation. But what about the rest of the 4 there? They're all grouped together.
Yeah, so we're getting back to more of global markets and where they kind of should be based on the economic conditions that everybody's experiencing right now. The countries that you could reasonably invest in without having to worry about the sovereign debt defaulting are at levels that are commensurate with our economy. You look at the communists, say the Brazilian government, and you look back at 2015 where there was the spike. You can see that yurt-like shape there back in 2015. We don't expect to see that too much unless there's some really national issues with that country. But right now, the value is with certainty and without the risk is in those 4 countries, whether it's the UK, whether it's Germany or US, all kind of tightened up there. But it does show a lot of value in the US debt. 68 basis points versus a negative 50 or 19 or 04. We're doing pretty good. There's value there.
Yeah, so it's really interesting to me that the world has come down to that we're going to be in a low inflation spot because of COVID and where we were coming into this. And all the major countries are all following the same path now. So that's something to me that I wouldn't expect that interest rates are going to change significantly up. And so if people think rates are going up soon, I struggle with that. They might come up a bit, but I don't see them returning to levels that we were years ago anytime soon.
Right.
So, great chart of the 10-year Treasury here.
Yeah, kind of shows where we are. We've been in a falling rate environment, and we talked about this when we were back in 2012, in 2016, and I'm going to mention again now, is if you graph this chart out back to the 70s, for the last 50 years, the average straight line has been a falling rate environment for 50 years. There's a lot of spikes, as you can see in the short here. So we are in the ultra low rate environment. It's going to be a slow slope back up. And it's just interesting to see that, people are still supporting the Treasury auctions at these levels. There are oversubscribed subscriptions taking place, whether it's a 10-year, or the 2-year, or the 5-year.
Yeah, it's just, to me, it's amazing. We've really bottomed, maybe not bottomed, but we've hit this bottom level here, and we've stayed there now. And if you look at the history of the 10-year Treasury, it doesn't stay at rates for very long. It's volatile, but we've been fairly non-volatile given what's going on here. So I always love this. Everyone knows I love talking about this chart because we have the Fed funds line in red, the 2-year Treasury in blue, and the black dotted line there is the 10-year Treasury again. And man, it's been quite a ride. Is one of the things that Craig did a great job of predicting in 2006, 2007 that we'd be low for 10 years. Or 2008, we predicted we'd be low for 10 years in interest rates, and we pretty much ran that course for 10 years. And we spiked up and potentially went up too fast. Some would argue in hindsight. I think we talked quite a bit about that in 2017 and 18 about how the Fed was overdoing it. But we're back down to these unbelievable levels. Hard to believe.
Yeah, absolutely. And if you kind of look forward, you see how the 10-year is kind of getting back above the 2-year and the 10-year. I'm sorry, and the 10-year is getting above the 2-year and Fed funds rate on the right-hand side. So as we stretch this out for the next 12 months or so, we're going to continue to see that positive slope is what we were talking about. It may not be quite as steep as we were seeing in back 2010, but it's going to slowly get there.
Yeah, heading in the right direction. Well, it's hard to see from the Fed funds rate here as we look at where we've been in the Fed funds rate, but man, it fell off the cliff like it did in 2008 again.
Absolutely. We're going to be in the range right now. Expectations are going to be for the next couple of years, and you can see you mentioned about too fast lowering things or too quickly. We don't want to debate too much historically, but going forward, I think they're going to be slow and deliberate in manipulating interest rates and have a lot of flexibility with inflation, and that means it's going to be a catalyst for them to work slow and deliberate.
That looks more like a yurt than the other slide, I think.
Well, you're probably right on that.
Well, and speaking of slides here, this is one of the scary ones to me. As we look forward here, the Fed funds futures are predicting 5 basis points here at year end or January 27 as the implied rate for cash, unbelievably low rates. Yeah.
Yeah, and you took that, and Charlie, you're looking across that bottom row there instead of the chart and saying, what is the implied rate for the futures? And even if you go out for the next 18 months, it's unchanged from the markets. Today we have the Fed open, the FOMC ends their 2-day meeting today, and they're going to talk a little bit about what their expectations are for individually for their dot plot going out into the future, out to 2023. There's rumor they're going to talk about 24, but we'll see if that actually happens.
Yeah, it's definitely going to be interesting here when we see what comes out later today. But I think the general comments we've had for quite some time now, those of you that have known us for a long time, interest rates are low and they're going to be low for a long time. And, we still are finding good things to buy. I mean, you guys are finding good stuff, but man, I hear conversations about why do I want to buy a 50 basis point yielding bond, and the response is, well, it's a lot better than a 5 basis point yielding cash position.
Absolutely. And with the liquidity, this is interesting to think about is that 5 basis points on cash, how long is it going to be here for, right? And what I mean by that is I mean the cash, not the 5 basis points. We already identified the 5. And with everybody's had the experience of a growth in their assets through deposits coming up. And, there's going to be stickiness to some of these deposits. Some are going to be 80%, some's going to be 50%, but there's going to be a lot of stickiness to it. And you got to be careful on managing your capital, but also that just means that what are you going to do with the cash? It doesn't make sense to hold on to it or all of it, invest it, bring up your ROA a little bit.
Yeah, if you look back at what happened in the financial crisis or the great crisis back in 8, 9, 10, is cash skyrocketed and it never went away. I remember going back and running all the surge deposit reports. When's the surge going to leave? And it never did. And so I'm nervous a lot of this is going to stick around also. So market yields, I mentioned earlier, some people are squirming at these rates, but they're still pretty good.
in
the big picture.
Yeah, and the important thing to be looking at here is credit spreads. And as you're looking to deploy cash into your investment portfolios, you look at this chart and you can see that the corporate curve, the taxable municipal curve, the tax-exempt municipal curve, the spreads between that and the agencies and the CDs and the treasuries, there's value there. You have to be careful from a risk standpoint, risk modeling, expectations, but there's opportunities in the marketplace for everybody to be looking at, whether, regardless of your situation, they're there.
Yeah, definitely some opportunity there with work. I think really being disciplined on your duration and like you just mentioned there, just good credit risk and being intelligent with your credit risk has got to be the right thing to do.
Absolutely. I was reading an article yesterday about, everybody's worried about municipalities and having a little cash crunch, schools with the new, reinvention of how they're learning with respect to online learning, which everybody's talking about getting a refund or reduced taxes or reduced tuition, but there's also expenses that go along with it. So they're just shifting some of those expenses, but there's a lot of federal aid that's helping all municipalities and states. And give the great state of Michigan as an example is our budget for 2022, we've got our numbers from the Fed and it hasn't been reduced. So, we don't have to necessarily worry so much about that. We just have to manage, the 2022 budget now and what's actually going to happen for a long period of time.
Yeah, I do think some of the municipal complaining is not a problem yet and will be in the future, and maybe a little more political viewpoint we're on right now. So it is interesting, but it's being good at credit is important and making good long-term credit decisions. So.
Right.
One of the reasons why we talk so much about cash today and thinking about this is, the margin. And this really comes down to the heart of what we're doing from an interest rate, or we're doing from a balance sheet management and where we're going. And reason why is really, as we look at this and what we've pulled from our ALM reporting system here at McQueen Financial, we went back since 2015, and now we've got the Q1 data for 2020. They're just rolling off the Q2 data here, so it'll be done probably by the time we're done with this webinar. But we're cooking along. But what I can really show you here is that we are seeing deposit costs still a little elevated. It always takes longer for term deposit CD rates to come down, especially as a lot of people were taking 5-year CDs coming into this. So that's going to keep it there. But we have seen overall non-maturity deposit yields come down quite a bit. One thing I would recommend is everyone just takes a good look at that and think about that, because again, we don't see rates going higher anytime soon. And when people save because they're scared, they're not really worried about interest rates. But something to think about from this, I think deposits are here to stay, and we want to be careful with that and cut the cost as much as possible. From here, asset yields. This is the other side of the equation. We're seeing investment yields slowly coming down at this point, and as we continue to go forward, hard to believe it, but we're going to lose what we thought were still low back a few years ago, 2.5%, 3% yielding investments to 50 basis point yielding investments. So our yield on assets are going to come down. We're seeing loans pay off and new loans being booked in the 4s, and so we're going to see loan yields come down, and so there is going to be a consistent reduction of asset yield, both loans and investments, as we go forward, unless we get some credit issues. We haven't seen the credit issues yet, but that may bump up those rates a little bit, but we're definitely seeing asset yields low, which is really then the component of all three is the margin. We're seeing here as the margins are really starting to turn down. We're seeing margins head towards 3%. We've seen some margins under 3%, but on average, we're still closer to 3.50. But we never fully recovered in margins, as a lot of people think back that they were big fans of 4% margins. So we're definitely seeing margins start to come down in the wrong direction pretty quickly today. So with that, I want to repeat this, but lower deposit rates as much as possible, and loan rates you can hold steady as you can. But really, one of the things to do is your discussion of asset classes between cash and investments and fully investing, because one of the things we have to be very cautious of is making sure we're making as much money as we can, because we are nervous about capital positions. Normally when I say I'm nervous about capital positions, it's from losses. This isn't from losses, almost everyone's making money. The issue is coming down to just the asset growth from the deposit growth that we've seen. And so making sure you're thinking carefully about that. We're also seeing reduced loan to deposit ratios. We're seeing lending as a challenge for a lot of places, which it's hard to borrow money in this day when you're uncertain about a pandemic. But thinking about that and a reduced loan to deposit ratio is okay. You don't want to force that in this environment. And I think that one of the keys is doing a good job in ALM, and our whole ALM department here is spending a lot of time working with our customers, making sure that we're using ALM and thinking about this carefully and really predicting where we may go and planning the future. Because a good chunk of what we're seeing is going to be affecting us here is a margin effect, but there's also some concerns to non-interest income as we go forward too. So speaking of that, non-interest income, our next section here before we hit into a couple predictions. And really to me, I think this is one of the toughest things. Craig, we're seeing some great activity on gain on sale of mortgages. We've seen that taking place. We talked about those high prepayment speeds. At some point, does everyone get refinanced that's possible?
I'm thinking there is, unless, we're up against some mortgage shop that's just going to be refining them for, just for the giggles.
Yeah. Nothing else to do.
Right. So, but it's been a great year for everybody on gain on sale and mortgages, and to the numbers of, they've never seen before. And we got to be careful, and it's really interesting to start thinking about what happens in 2021 when our mortgage volumes cut in half. And I'm not saying it will, but hypothetically, the simulation. And how does that affect your overall earnings in that environment? So we really got to think about those gains on sales. We want to continue to encourage it.
Right.
But we also want to model what happens if it goes away.
We're doing that for a number of people now, and one of the impetuses of that has been the diverse market fee that Fannie and Freddie are implementing now on December 1st, which should actually cause, we would expect, the slowing of some refinances. That bumps about 25 basis points a yield, the 50 basis point fee does. Another thing we have is the PPP loans. They've been an awesome way of our clients to generate loans and put loans in their books, but they're starting to pay off. And so that we're going to see that fee income, it's going to be wonderful for the next 3-4 months, but then the program's done.
Mm-hmm. Yeah. So, be careful. You got to really look to other sources of non-interest income, and as we see these kind of fade away.
And thinking through this, alternative portfolios for credit unions, thinking about your broker and your lobby structure, PPP loans or SBA effectively are government guaranteed loans, but SBA loans and gain on sale, insurance, everyone needs to have some sort of expertise in their organization. So with that, getting into projections, I think we did a great job back in March of 2000, as we also did back in 2008. But March 2000, we predicted that COVID was going to be growing through June and be done by September. I think we were a little overzealous about being done by September, but listen, the number of infection cases is declining substantially and hospitalizations declining substantially. So we're right on direction, but done was probably a little bit strong of a word. We did predict interest rates low for 5 years at that point, and we're now a year or 6 months into it, so we're not too far along. But those seem to have gone well. And our focus points today, which change a little bit, is as we go forward, to really worry about margin compression. Delinquency is going to come back, especially if you're in areas that are higher affected, towns that maybe have a lot of conventions. You've got a lot of hotel and restaurant loans. We're definitely going to see those losses back to normal. Earnings without non-interest income is just going to be lower because of the margin compression. And I am worried a little bit about loss of fee income if we see, when we see the PPP loans go away and potentially the mortgages shrink. Loan to deposit ratios are going to decline. So all that is going to hit. But now as we predict forward, Craig, how long are interest rates going to be low for?
Right now, firm for low rates for at least 4 years going forward. Remember, there's volatility in the marketplaces. The 10-year may leak up to, one with a 1 handle on it, maybe a little bit above it. It's still a relatively low rate environment. I don't expect the Fed to intervene really much at all to be slowing down the economy because it's not overheated whatsoever. Which tells us the Fed funds rate is going to be, relatively close to zero for a foreseeable future right now.
Combine that with a lot of political uncertainty, and we'll get a rebound in GDP, but definitely a lot of difficult spots. And So with this, we're going to be sending out tomorrow our full economic write-up with our individual interest rate projections. For today, if anyone's working on budgeting and planning, take the yield curve as it is today, project it there 1 year forward, and you're not going to be far off. So we do expect low interest rates for a foreseeable future, definitely a lot of uncertainty and a tougher economic standpoint, potentially as COVID wears on for a little bit longer period of time. So our parting comments, make sure you're reassuring your members or customers and your internal team that we're here, that you're there to help and help everyone through this. Definitely a difficult time for people, unique environment that we're in here. Make sure you're planning your balance sheet with ALM and thinking carefully through it. Something we want to make sure we're looking at. MSR values are changing significantly. Make sure you're heading down that path and getting those valued. Be fully invested, something that's really, really important. And then from there, make sure you continue to focus on other sources of non-interest income. And then last but not least is CECL. It's coming. What I mean by that is you should have started by now. If you haven't started by now, it's time to start CECL and get fully adapted there. So with that, we're going to open up to questions and answers. We have about 6 minutes or so left before we hit our magic hour. First question that we have here, please, if you scroll down to the bottom of your screen or the top of your screen, you'll see a line open up. Q&A will be there, so go ahead and click on Q&A and enter your question, and we'll address it. So first one that came across here is, how do you suggest credit unions or banks make decisions on how much excess liquidity to invest? All of our excess liquidity is related to the substantial deposit growth. And I think this is a question, Craig, that you've had on a regular basis is we are seeing lots of growth coming in from just the nervousness, the amount of money the government's been handing out. What's your answer to how much should you invest of that money?
Sure. It's a really good question, and it affects every single person on this call. And it boils down to, I want to answer it in 2 steps. And one is we're really pointing towards liquidity stressing of the balance sheet. Meaning, what is our normal liquidity that's our balance sheet is generating on a monthly basis, on a go-forward basis. And that helps us determine for each individual client in your specific balance sheet how much we can invest. Because we don't want to actually take all of it and put it out in a duration that makes sense based on the curve. We have to keep in mind that some of it may go away. I commented earlier, some might be 50%, some might be 80%. You notice I'm not saying lower than 50 because I do believe we're going to have a lot of it around. So ultimately, if someone has a target of cash on their balance sheet, call it of 2% of assets or 3% of assets, I'd add a couple percent and leave it at that. But make sure that we use most of that and deploy it in a reasonable manner. Maybe not quite as long as we traditionally would invest it.
And so I think back as normally we see somewhere in the neighborhood of 5, 6, 7%, lowest 3, 4% of cash on people's balance sheets. And I think maybe a little higher than your long-term average, but I wouldn't be significantly off your long-term average. And that's the way I think of it. Another question that came across is what areas are you investing funds in today? What asset classes are you investing funds in today?
Certainly, good question. We've been really focused in on credit-related product for the incremental value that you're getting, and that's in taxable municipals, bank for tax-exempt municipals for people on call that are from the banking side, corporate bonds to a certain degree, and then we are doing a lot of very well-structured mortgage-related product. Not that can't have and will not have a lot of extension risk. Because of in this low rate environment, you don't want to have all that extension risk. And even if interest rates do go up, call it 50 basis points, you've got to mark to market. You're not marking to market, but you got unrealized loss there. And that, even though it's a very liquid security, you might not be able to afford to sell it if you need that liquidity. So it has to be very well structured and very well researched. So, credit related with some very well structured mortgage related product.
Perfect, thank you. Question that popped up here was, do we expect there would be a housing market crash? And, there's some conversation about it. I don't foresee a housing market crash, and the reason being is it's simple supply and demand. There are more buyers of houses today than sellers. While home prices are definitely up, we're in a lot of markets just got past the high point that we hit in 2008, which means you've had zero price appreciation for 10 years. 10, 12 years. So I do think that we're not in a crash position because it's real buyers, not people buying 2 or 3 condos. And we think back to 2008, the stories of people owning 3 or 4 condos in Florida and multiple houses and flipping them. We're not seeing that here. We're looking at people buying for their families, and that's a very different activity.
Right. I want to add just a comment onto that, is as we do look to lend in a going forward basis, and that question sometimes will say, well, if that's the case, I'm not going to see a devaluation of my collateral. Let's get a little bit more liberal or underwriting for say, houses or for other asset classes. But something you mentioned earlier, Charlie, in addition to houses being really overvalued, is all these types of different recreational vehicles. Whether it's a boat, whether it's an ATV, whether it's an RV, these values are really high. So just be really careful on loan to values as you're booking into this, because we don't expect a crash. I concur. There might be a slight devaluation if something unforeseen happens, and so we want to make sure everybody's protected.
And another thing too is there may be a continuing trend of people leaving cities. We used to have people leaving the rural environment going to cities, and that seems to be reversing in a number of cities. So we may see some areas that are having some price depressions. There was a quick question here. Are there any downgrades so far in the muni market? Do you foresee these coming in the future due to lower expected taxes? And, we've been actively selling some municipal bonds where we have concerns about the tax revenue and spending a lot of time doing some analysis. So I do think there are going to be downgrades. But Craig, how do you feel about that?
Yeah, that's a good point. I know the third-party rating agencies have been slow to move on any kind of downgrades. What we're really concerned with are the revenue bonds that are specific to certain projects and revenue sources. And so in that arena, I would expect a lot more downgrades than in the general obligation space that's doing, say, property tax revenue. Another dedicated revenue source is like sales tax revenue. So it just really depends on the sector within the municipal market that we do have concerns with. And but as long as you're going in knowing and not buying something just because it's the best yield on the revenue source, you should be okay. You got to be actively managing those holdings. Do your homework and read. So another question here, and our last one we'll do, is we're running out of time here at 2:01. Is there any plausibility that NCUA Chairman Rodney Hood's push for Creighton to be exempt from CECL requirements, that the push will be successful? And the answer is no. They have now come out and effectively said that they're going to go forward with CECL. And the other reason being is it's already been implemented, and the goal here is to have banks and credit unions on the same system so there can be a comparison. So our expectation is that CECL will continue to go forward at this point. So with that, I want to thank everyone for joining us today at our webinar. Really good to spend some time here with all of you. Really appreciate that, and we appreciate the relationship that you have with McQueen Financial. If you have any further questions, please feel free to reach out to myself or Craig Cecilia, and we'll continue through and answer those questions if you have time. Also, if you'd like a copy of the webinar, please reach out to your advisor, and we will get you a copy of this. I hope everyone is having a wonderful, wonderful day, and I look forward to talking with all of you personally soon. Thank you very much.